Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, it is CPI day. We've got a few things to discuss. We will talk about inflation, the market's reaction to inflation, what's been going on the last couple of days. Tomorrow is FOMC day. We will get a rate decision. We will get a press conference. There will be volatility abound. We have several things to discuss. I'll talk to you guys about what I'm thinking about the CPI, what I think that the market will do over the next few days. I've got some probabilities and some frameworks to look at. We'll also look at past bear market fractals and try to marry all that together into an outlook for the next few days. If you enjoy this content, make sure to give my video a thumbs up and subscribe to my channel. And with that, we will carry on. Let's get to it. So all the markets are green this morning. They ripped up really violently in the pre-market as soon as the CPI report dropped, which was about an hour and a half ago as of right now. And we're about 30 minutes into market hours, but we're seeing the pump from the pre-market cool off a little bit. If I flip to a 5-minute chart and you look over here at the S&P, you can see in pre-market it shot up. Right here was the open. There was a bit more of a squeeze and it's now curling back down near the open price. Everything else is kind of following suit. And I think this is going to be a volatile day. I don't think that this rally is just going to continue in one direction the whole time. Almost no CPI day so far this year has been like that. The vast majority of CPI days have been red. All of them have been volatile. So I don't have a clear bias about the direction I think we'll be going in today. I do have some opinions about this rally and where we are in the bigger cycle, which I'll talk about in this video today. But right now, just kind of watching this action. And, you know, if we look at the resistance on here on the S&P, this is the S&P future. We talked about this a few weeks ago on this channel when we were down here. We were talking about how maybe we'd get up to this level. If we found it as support, maybe we'd then move higher into this range. Well, look, here we are, guys. We're in exactly that spot. And the real question folks are asking themselves is, will we curl here or will we manage to keep going higher? That's really difficult to answer. I could be wrong about the rally stalling out here, but still be correct that the bear market will continue. So I don't know exactly what's going on here. But if we just look at this big picture from our fibs, we're just barely at the 0.5. So this is only halfway retracing from all the way on the top. And if we look just at this prior leg, which is a little bit more relevant, we've just broken over the 786 retracement right here at this level, this consolidation area from June. So that's the 786. That's where we're curling this morning. And in fact, if I go down here on low time frames, you can see it curled right at the 786 perfectly. So that's something I've got my eye on right now. It's not an ironclad rule that the 786 has to reject, but if we started dancing around in this area up here, then we'd have to start looking at this level and then maybe thinking about a peak above as a test of the market. We're not there yet. We may not get to that point, but we have arrived at the place that we discussed a few weeks ago on this channel. My base case, big picture, is still that this bear has further to go, and I'll point out some of the reasoning behind that here on this video today. The VIX got absolutely smoked this morning after a huge day yesterday, which came at the same time as a relatively big green day in equities. That rarely happens. It's very uncommon for the VIX to have a big green day to the upside. The VIX represents implied volatility, while at the same time the equities market is also having a big day to the upside. It's very rare. And in fact, the last time that the VIX and the S&P both were green to the degree they were yesterday in correlation with each other was in the 90s, the 1990s. So it's been more than 2 decades, an extremely rare event that actually continued in pre-market this morning before the VIX got smashed. See, if I pull out here, you can see the VIX kept going up here in pre-market and then right at the open got utterly demolished as equities pumped. So that was a pretty interesting dynamic. The VIX proved to be the one that was wrong of the two. DXY also taking a huge leg down today, and if we zoom out on this, it's sitting right at high time frame resistance, right? So we've got this kind of channel that the dollar has been bouncing around in here, and we are now perfectly at that level, which is right at a 104 for the DXY. I still think that the dollar has a high risk of going higher over the next year, but it doesn't have to happen linearly. Nothing in markets goes in one direction. So we're pulling back to this resistance here. Maybe this is where we find support around 104 DXY. Maybe we get a little swing failure to the bottom and then we move back up. Something I'm watching for. Bitcoin, there's just not much great to say about Bitcoin. If we want to look for some upside here, it has pumped this morning. It's about 17,800. A lot of the low information Bitcoiners on Twitter are just mega excited about this price here. But this is just a pump like everything else is pumping. There's nothing to really read into about this. Don't get too carried away. It is nice to see that price has broken over this trough that had been dug out ever since the FTX collapse. These candles back here are from when FTX was going into bankruptcy and collapsing. So we're finally back over this lower level that we were digging around in, but I think there's a high probability that we just come back down. Again, it's non-linear. A lot of this will play out over the next few days. And this is a really volatile and risky week to be making bold directional calls. So we got the CPI report today, which we'll look at a little bit. And then tomorrow is FOMC, when we get a rate decision and a press conference from Jerome Powell. There are also a bunch of other central banks around the world who are making rate decisions this week. So it behooves anyone actively in the market to be aware that there are a plethora of exogenous factors that could play a role on the price in your given market. Definitely a time to be extremely cautious and defensive and protect your capital. And speaking of the Fed, what we're looking for is a raise of about 50 basis points in the federal funds rate, which is currently around 3.75, 4%. That would put it at about 4.5%. But what's really interesting is that the 2-year yield is coming down dramatically. Now, we've talked about this several times on the channel. Some of you who've been watching for a while might have heard this spiel before. But in all prior hiking cycles, as soon as the federal funds rate met the 2-year treasury yield, that has marked the end of rate hikes for that cycle. You can follow that trend all the way back to the 80s. They're marked here on these red arrows, and I've got a question mark here on the current market because we're waiting to see what happens. If you look down at the bottom, this is the 2-year federal funds yield curve, and this top line here, which I will make solid to make it more clear, this is 0. This is inversion. So when you see red below this solid black line, that means that the 2-year is below the Fed funds rate. And when that has happened, like I mentioned, that has been the end of whatever rate hikes had been ongoing at the time. In 2019, that's what triggered the Powell pivot. Here we are now, and the 2-year is giving Fed funds about 40 basis points, which is essentially the 50 that we expect tomorrow. But what I'm taking away from this is, historically, if we believe the Fed funds rate is going to stop going higher when it meets the 2-year, then in theory, tomorrow might be the last rate hike. Now, that trend has only existed in the perpetual downtrending yield environment that we've been in since the 80s. So maybe that trend breaks this time around. We'll have to watch and see. And if it does, the market reaction could be very volatile because this is a signal that more and more people have been watching. I've been seeing more folks tweeting about this relationship, writing reports about it. So I think that this is being highly watched. So here is a prettier version of the chart we were just looking at. The same lines are included. Over here, we've got the red is the federal funds rate, black is the 2-year treasury. At the bottom, we have their inversion. Same thing here. Fed funds in red, 2-year in black. At the bottom is their inversion. This just kind of helps you visualize it a little better. But what I really want to draw your attention to are the numbers on the labels down here. So each time that the inversion has taken place, where the 2-year has broken below the federal funds rate at the end of hiking, and each time that that has occurred, the inversion has been at least 50 basis points. That was back in 1995. That was the narrowest inversion. It was 56 basis points. The second narrowest inversion was in 2020, and that was 66. All the others have been about 125 or more basis points, all the way up to 2 full percentage points down here in 2008. What this is showing is that every time that the inversion happens, because yields have continued to fall as the economy has slowed down and people bid safety, it's caused an inversion. And that has occurred during the pause. You see how the Fed funds rate plateaus and goes sideways? This has been a trend in the last 30 years or so, where the Fed hikes rates up to a certain plateau, and they try to keep them there for a period of time before they begin cutting. That's been the case in all of the instances on the chart here. But if you go back before this era, if you go back to Paul Volcker and earlier, there were more volatile periods where rates would spike up and then immediately come down. A lot more change in the federal funds rate. But here we've got these plateaus, and during each of these plateaus, that's when the inversion between these two metrics really gets deeper, and it's usually about 150 to 200 basis points before it comes back out of inversion and before the recession really starts. Also, before the cutting really starts, before the reduction of interest rates. So what I think that we've got to look forward to, if we look over here, we've got about a half a basis point between the two. Now this data is not up to date. As of right now, it's actually 42 basis points. But on my chart here, from the last time I updated it, it was 57. But you can see all these other troughs are a full percentage point or more away from where we are now. So I think we've got some time to wait where the Fed will maybe hike tomorrow by 50 like we expect. It'll be right at the 2-year. Now maybe the 2-year leaps higher. We've seen these other times in the past where the 2-year yield has ripped higher in very short order and kind of played keep away from the federal funds rate. That even happened, there's a little spike here back in 2000, a really sharp spike right before the first interest rate hike. Maybe we get another one of those. That's really hard to say, but I do think we're near the end of the hiking itself. We're close to a place where the Fed may pause hikes and keep them here for a while. They may try to get to 4.5%, 5%. They may struggle to do that. We'll really have to see over the next couple of months, but we're nearing that place historically where rate hikes come to a conclusion, and you can see that on this chart. Now, the reason the markets are pumping this morning is because CPI surprised to the downside. It was expected to be about 0.3% month over month, and it came in at 0.1%. And so the year-over-year measurement for CPI is now at 7.1, down from 7.3 or so last month. Now, in terms of the pieces inside of the basket, some things have started to change. Medical care services have come down a bit. Energy has come down. We're seeing used vehicles falling month over month at an accelerating pace. That's really helping out with the CPI. But then there are some other places that have remained kind of sticky. So core CPI, that's everything minus energy and food. It has slowed down over the last 3 months, but it's still accelerating month over month. So in November, it was 0.2. Core services, still accelerating, but at a slower pace. Shelter, consistent, 0.7, 0.8, 0.6%. This was really expected because shelter is one of the slowest moving pieces of CPI. But what caught my eye from here is that food, we see protein-rich foods have come down a little bit. That's like meat, poultry, eggs, fish. But food broadly is still going up. Food hasn't chilled out even a little bit. And if I show you here on a chart, so this black line is all food, this red line is called food at home, which is like a proxy for groceries. And both of those as an index, this is not year over year, this is the raw index, still going up, haven't slowed down even a little bit. So food is still rising. There are still inflationary pressures going on in food. So we've gotten some softening in the CPI basket. Couple parts of the services are a little cooler. Used vehicles looking a lot better. New vehicles slowed down to almost flat. There was no change last month, but also still some sticky pieces of the basket. Now, one of the tools that I've been watching for inflation is the Inflation Nowcast tool, which is by the Cleveland Fed. It's an algorithm that tries to predict CPI based on a number of inputs, and it gives a projection every business day in the month leading up to the CPI report. Up here at the top, these colored lines represent the trajectory of the CPI projection, and the colored triangle at the end of each line represents what the final actual CPI report was. So you can see that the difference between the line and the triangle is how off the algorithm was. Down here at the bottom is the same relationship, except instead of the triangles, I've got this line going across the middle of the screen. So this line represents where the triangles are. So when you've got these down here, you can see from October of last year up until June of this year, all of these projections were below the final CPI. So CPI was outstripping the projections of the model up until June. And ever since June, in July, there was an overestimation. And then for a couple of months in August and September, the algorithm was dead on. It was spot on perfect. And in the last couple of months, it is again overestimated CPI. So you can see this almost represents the rate of change of CPI itself. In the first few months from earlier last year, when it was really accelerating quickly, the algorithm was undershooting it every single month by 2 to 3/10 of a percentage point. And then once we got to July and CPI's rate of change really started to slow down, even though it's still accelerating broadly, its rate of change started to slow. And now the algorithm got a little more accurate, and in the last couple of months has been overestimating by 0.3 and 0.4%. So we're starting to see a turning of the tide with inflation. That does mean that we have a chance that it starts to come down meaningfully over the next few months. But I would caution anyone who's eager to call the top in inflation that when you look back through the history of inflation, represented here on this black line, it's extremely volatile. You can see in the 40s, it spiked multiple times. In the 70s, it spiked multiple times. We are on the first spike. So I think it behooves us all to remain very rational here and very calm and keep historical context in mind. And inflation is not a one-shot trend. It's usually a multi-shot trend that occurs over a period of many years. I believe that's what we're in now. I think we will see more than one of these inflation spikes by the time we get to the end of this decade. Now, one thing I mentioned was how the VIX was up big yesterday and even this morning at the same time that equities were up. So what I did yesterday, I crunched 30 years of S&P and VIX data. So I took all of the VIX values going back to the beginning of 1990, and I said every day that the VIX closes at a particular value, what is the forward 30-day range of the S&P? So yesterday, the VIX closed at 25. And based on every day of market history going back to 1990, every time that the VIX has closed at 25, rounded to 25, the next 30 days have had a range of about 5.2% to the upside and about 5.2% to the downside. It's been relatively even. And I did this distribution for every VIX value going up to the highest it's been in the last 30 years, 83. And so I took this information and I used that to project the future range of the S&P based on yesterday. And now again, I did not filter this for any kind of market conditions. I didn't clean up the data in any other meaningful way. It's just the pure averages based on the VIX close on a given day and the 30-day range after that. I used 30 days because the VIX is an implied 30-day volatility metric. So we're using time frame alignment here. So based on all those calculations and with a VIX of 25 from yesterday, it's telling us that the possible range for the S&P over the next 30 days is between 3783 and 4198. Call it 4200. So let's draw that area on our chart here so we can see how it aligns with what we've already looked at. So let's see, we got 4198, which is about right here, to 3783, which is about right here. So this is the range based on the VIX yesterday that the S&P historically travels in over the next 30 days. And what I find interesting is that the pump from this morning got right to the top of that box. That gives me a little bit of confidence that maybe this model has some validity to it. And also, interestingly, the ceiling that it gives us for the probability is just over the 786 retracement, which is the final retracement leg on this move higher from the previous correction. Sometimes bear market rallies can go higher and set a new higher high before faking out lower. That is possible. But most rallies stall out between 60 and 80% of the retrace of the prior leg down. That's the wheelhouse we're talking about right here. That lines up with the top of this model. So I think that we have some confluence. It doesn't mean this level has to hold. Again, these are just historical averages. But based on plausibility and based on the action that actually caused this pump this morning, which was really just an algo reaction to CPI, so based on all those inputs, I think it's very plausible that we're at the end of this bear market rally. And speaking of bear market rallies, so I have a chart that I've been collecting all of the bear market pivots. And we talked about this on my last video, how I tracked all these pivots, the percentage moves of them, and I counted them in prior bear markets. Well, this most recent leg higher, this one that went here, I stopped counting here on December 1st. I haven't updated it yet. But just looking at this rally right here, that particular piece, that move from October 13th to December 1st, was the 24th largest bear market move in the history of bear markets. In terms of up moves, it was the 1, 2, 3, 4, 5, 6, 7, 8 largest up move in the history of bear market rallies. Here, let me turn off all the down so we can make sure. Yep, right here, number 8. So of all bear market up moves in the history of bear markets that I've tracked, which is going back about 70 years, the move from October to today is the 8th largest. It might even be the 7th largest now. I haven't updated it. So it's conceivable that we have reached the end of this move because we're near the kind of top end of what a bear market rally usually looks like. Some of the biggest ones in history came in 2000 and 2008, and this bear market is not as bad as those yet. And additionally, if we're going to talk about where the bottom is, I think it's important to keep in mind that history has a strong opinion about where bottoms live in relation to the events that play out in a bear market. So if we date prior bear markets based on different events that occurred during them, and then we look at where the bottom of the market occurred in relation to that event, we can get an idea of whether or not we think the low is in for this market. So if we look back, each of these colors on here represents a different bear market era. You can see them down here at the bottom of your screen. We've got 1974, 75, 81, 82, 90, 91, 2000, Great Financial Crisis, and 2020. Now 2020, I included all the way back to when they started cutting rates in 2019. So we got a whole year up to COVID. And now the interesting thing about this, all of these bear markets are dated from when easing started. So from when the Fed started cutting interest rates. That is historically a thing that they do near the beginning of the bear market. Usually the market starts declining while they're cutting rates, and they go down together until an equilibrium is reached. So what are we looking at? Well, each of these black triangles represents the low of price for that market cycle. This black line going down the middle of the screen represents the day of the first Federal Reserve interest rate cut in that cycle. What you will note is that every one of these triangles is after that day. So the bottom of the market came after rate cuts, not before. Additionally, all those same bear markets dated from the start of recession. Again, the exact same trend. The bottom of every one of these markets came after the start of recession. At minimum, it came 35 days after the start of recession, and that was in 2020. That wasn't even really the kind of bear market that we talk about. That was more of an economic flush because they shut down the economy and then they pumped a bunch of stimulus back in. But it did create a recession, so it's included here in this data. But other than that, it's usually months. So we haven't even gotten to the place yet where we could say we're in an official recession. There are people who think that we are. There are certain indicators that suggest that we are, like negative GDP growth for 2 different quarters this year. But unemployment is still at historical lows. We still have wage growth. We still have a lot of companies with positive earnings expectations next year, which seems radically tone deaf to me. But all those things kind of add up to inform us that we have more to go in this bear market. We have much further to go. We have not begun to see any of the normal indications that suggest a recession has actually started, though we do anticipate it will start in the relative near future. Probably in the next quarter or two, I think we will be in an official recession. But none of that is going to come until we first start to see earnings falling and unemployment getting worse. This is our hope cycle chart that we talked about a couple of videos ago. Each bear market, reliably going back many decades, has a sequence of events that play out. Usually the housing market starts to slow down first. It's highly interest rate sensitive. Housing goes first. Then we start to see manufacturing and business conditions, the expectations of the future, starting to get weaker. PMIs contract. New orders get weaker. That's here in the green line. Housing was up here at the top. We've seen housing curl over, PMIs are now in contraction. Earnings expectations have not come down yet. Unemployment still at historical lows. It's inverted here, so the low is up at the top. So we are between these two slowing down and these two slowing down. We haven't gotten to an official recession. The Fed is still hiking interest rates, not cutting. So all of those are informing my base case that we've got at least a few more months to go, if not the majority of next year. And just to kind of emphasize for you how fucked up the timing is on this current bear market. This is every bear market going back a really long way. You can see I went all the way back to the 50s. I even included the Great Depression on here. This is the high of the market, dated from how many days it has been since interest hikes began. Since rate hikes began, since tightening started, which usually starts before the bear market. Most of the time, they raise interest rates into a strong economy. The economy is getting stronger. The market is going up. They're raising interest rates until it reaches a point that they can't push anymore and everything kind of rolls over. So normally they're tightening into strength. And that's why in every bear market before this one, 1929 through to 2020, all of these have positive values over here because all of these market highs came well after the Fed was raising interest rates. The closest proxy is 1981-82, which was only a 36-day window, and that's because Paul Volcker jacked up interest rates again after jacking them up the year before to try to firmly kill inflation, to finally beat it into the ground. So we had a double dip recession, 1980 and then 81-82, and that's why this number is so low. However, look at this one. It's negative. It's 2 months negative, 71 days. So we had a high in the market over 2 months before they began hiking interest rates. So the timing on this market is completely screwed up. There are other aspects of it that are also out of whack, but I think this one really captures it. They didn't begin tightening until the market had already peaked. Now, maybe that means that they have to reverse course sooner than they would like. That's one assumption we could make. The other assumption we could make is that this whole saga takes much longer to play out than we thought and is a lot uglier and more painful than a typical bear market. I'm not making that statement. I'm not declaring that that's the case, but I think we need to keep that in mind. The entire sequence of events here is completely thrown out of whack because of the delayed reaction of the Federal Reserve, because they kept rates low for far too long into the bull market. And it wasn't until the market actually rolled over that they started raising interest rates. I mean, for the love of God, they were still buying $100 billion of treasuries per month after the market peaked. They didn't stop QE until like February or March. We will not fully see and recognize all the effects of the tightening that we've undergone this year until next year. By looking at this data in this way, I hope that I am informing you as well that this saga is nowhere near over. There are a lot of people who are antsy to call the bottom, who are itching to be able to identify any hint of dovishness out of the central bank. I expect that that will continue. It will create more volatility, but I don't think that we're anywhere near the actual economy improving. We still have to digest all of the policy changes that have been enacted this year, and we're just not there yet. It takes many months for these things to play out, and we just had a relatively positive earnings quarter. So I think that we won't really start seeing these things change until January or maybe April, May of next year. We'll have to watch and see how these things unfold. But that's kind of what I'm looking at here. I'm looking at a bear market whose timing is completely out of whack. I'm looking at all prior lows in previous bear markets coming after the start of recession, coming after the start of interest rate hikes, and we are still raising interest rates. We've seen that the inversion of the Fed funds and 2-year Treasury can get as deep as 1.5 to 2 percentage points. And we're still 50 basis points in the positive. So maybe we've got another couple of months of this little dance to go before we can start to see cuts coming in from the Fed. I would imagine they will try to keep rates elevated. After all the work they've done this year to convince the markets that's what they want, I don't think that they're going to turn on a dime. They're going to need to be really forced to turn their position around, I believe. Though tomorrow will inform us quite a bit. We need to hear what Jerome Powell has to say, and maybe that changes some of the tenor of the conversation. We'll just have to look. Based on the VIX yesterday closing at 25, we think that maybe the high of this rally could be around 4,200 on the S&P. And when we look at where the S&P is, that's not too far from where we are now. This wick this morning reached up to 4180, and my model says 4198 is the historical high based on where the VIX was yesterday. Also, that is the 786 retracement. So this is the last real stand for this retracement to be following norms and not to go up and threaten a new high. But it can do that. The Dow Jones just proved it. So we need to keep these probabilities in mind, these frameworks. I don't have any kind of absolute call that I'm trying to make here. It's a really volatile day in the markets in the wake of CPI and less than 24 hours before FOMC day. Keep your heads on a swivel, friends. This is one of the toughest times of the market. And I hope that you are recording both your own personal experience and your observations at this time. Write them down. Create a Discord for yourself and use it as a journal. Keep notes in your pocket. Do whatever it is that you can do, but write down the things you're thinking about, the things that you hear other people say that you find really insightful. If you read something that you think, man, I really want to remember that for next time, write all of it down. Look at it occasionally. Log it into memory and take this experience forward with you, because this market condition that we're in right now, this is the tuition that you must pay as a market participant. Financial markets levy a steep tuition upon all applicants, without exception. Every single person who wants to invest and trade the markets must pay their tuition. Everyone's cost is different, but everyone pays it. And it's paid in the form of hard lessons. You can educate people, you can inform them, you can try to train them up, but at the end of the day, most people in the markets specifically only learn the hard way. It's a savage Darwinian beast. And these conditions, the last few months of price action, have been one of the most cogent lessons that anyone in the market today will experience. And I hope that you're making the most of this, that you're taking some positives out of what is otherwise a relatively negative experience. Make sure you follow me on Twitter at TXMC Trades. That's where I post a lot of my thoughts and my analysis. And also, make sure you check out my newsletter at alphabetasoup.io. There's a link in the description down below. There's also a link on my Twitter bio. That's where I post a lot more of my analysis. I share more of my charts, and it's just another way to get my content. So go check it out. And that's where we'll leave it today, guys. I know I kept you waiting for a couple of weeks. I've really been juggling my personal time a lot, and it's been hard to carve out enough of a day to make a video and not get interrupted. But I am working on it. We'll keep making the content, and hopefully there'll be a day in the future, hopefully not too far away, where I can really commit more of my time to doing this. But I'm just not there yet. That's it. I've talked a lot. The total recording is about 45 minutes long. I'm hoping I can cut that down quite a bit for y'all. We'll see. We'll observe FOMC tomorrow. As you guys know, I'm really keen on the press conferences and the tone of the questioning in there, so I'll be watching that, and we'll talk about my review and my thoughts of it in the next video, most likely. Take care of yourselves. Don't overexpose yourself to the market on a week like this where you really don't know what's going to happen with price action. I do still have a base case that the bear market is not over and that we will go lower from here, just based on the historical norms of a bear and some of the events that we just haven't gotten to yet. I hope you take care of yourselves. I hope you find time for some personal enjoyment. Get outside, touch some grass, hang out with the family, and we will chat again in a few days, friends. Make no mistake about it. So until then, cheers, everyone.